Mortgage rates open this morning at 6.39%. Yes, that's up slightly from last week, 6.37, all while the Fed's favorite gauge of inflation, PCE, released this morning right in line with expectations. But the bigger story is why waiting for lower rates for our clients could ultimately backfire. So let's dive into it and discuss what drove the market this week and the message we need to be bringing to our clients to ensure that they are set up for success. So, as I mentioned, PCE, personal consumption expenditures, Fed's favorite gauge of inflation, something you've heard me talk about in multiple iterations of this update. It was released this morning, and both core and headline came in right at expectations. And we have started to see a slight rally on that news. As we know, the Fed is focused on bringing inflation down, and really that inflation trigger comes from PCE. So we dodged a huge bullet this morning, because had that come in higher than expectations, well, this update would have gone a heck of a lot different, as interest rates would have been moving higher yet again. So yes, today we dodged a bullet. That said, though, there is a ton of headlines, and I know because our clients are sharing that information with me. They are waiting for lower rates. We've seen countless administration members, pundits, economists indicate that lower rates are in front of us. They are coming. Most notably, Treasury Secretary Scott Bessent said earlier this week that the Fed is going to cut. We want to see 150 basis point in rate cuts, which in turn will produce significantly lower mortgage rates, which I know ultimately our clients have heard, because the conversation we're having is, hey, I want to wait for lower rates. Well, here's the stinger in that. As we know, the Fed cut for its first time in this cycle on September 17th. Since the Fed cut, mortgage rates have continued to move higher, much like we saw last year when the Fed cut in 2024. Why that's important, and the narrative we should challenge, is that waiting for this lower rate environment could ultimately cost you. We know there are a ton of people sitting on the sidelines, and right here and now, and as we saw last week, rates are still at the best levels we've seen in multiple years. Taking advantage of the opportunity now while everyone's focused on, hey, we're going to wait, could produce massive results, not only for our buyers, but also our sellers. And importantly, our clients that purchased in cycle highs that are sitting in rates above 6.5%, 7%, 8%, an opportunity to restructure that debt now. So again, the talking point we need to take away is the Fed does not control mortgage rates. The market, as I said last week, moves to its own rhythm, and interest rates for mortgages follow ultimately the market. So here, sitting and waiting for lower rates, where yes, I do definitely believe we will see them at some point in the not so distant future, hopefully. Take advantage of the opportunity now. Our buyers need to know that there's competition, but the competition is not as fierce as it would be if interest rates were, say, in the fives. Our sellers, an opportunity to negotiate with buyers and still command the price that they want. And yes, homeowners that got into mortgages when rates were higher, now is the time to look at with your mortgage professional to restructure that debt. That said, as I said earlier, the Fed does not control mortgage rates. The mortgage rates are going to move based on their own direction. If you're having challenges communicating this message to your clients, please reach out. We'd love the opportunity to assist. And as always, if you find value in this content, please subscribe to the channel and forward to anyone that you feel would benefit from this. As always, let's make it a great day and an even greater weekend.